Silver just stunned the entire market again, smashing past $59 and coming within inches of $60, and anyone pretending this is just another random spike is kidding themselves. Something deeper is happening under the surface, and most people aren't paying attention because they're too distracted by the excitement instead of the actual drivers. If you think this move was just holiday volatility, you're missing the real story. Silver didn't just wake up. It reacted to pressure that has been quietly building for months, and today it finally showed itself on the charts. This move wasn't an accident. It wasn't luck. And it damn sure wasn't manipulation. There's a real trigger behind it, and the surprising part is that most investors aren't even watching the right metal. Before we break that down, welcome to Gold Rush Reporter, where I break the noise, cut the hype, and show you what's really happening in the gold and silver markets. If you care about timing, fundamentals, and long-term positioning, this is where it all gets decoded. Now, if you're watching this move in silver and you think this is the top, think again. The data is pointing in a very different direction. Drop your thoughts in the comments. Do you think silver hits a confirmed $60 close this week, or does it pull back first? Today's price action was wild for one reason. The metal split. Gold pulled back, platinum weakened, palladium moved higher, and silver exploded. Whenever you see metals moving in opposite directions like this, that's not noise. That's structural tension. It means something underneath the market changed, something that affects industrial demand, liquidity flows, and expectations for the next quarter. We saw this pattern twice before this year, and every single time it revealed a hidden pressure point. Today was no different. Gold slipped to around $4,000 after hitting $4,160 earlier, proving yet again that gold is struggling to hold momentum at the top of this range. Silver, meanwhile, surged like it had been waiting for a signal. That signal wasn't gold. It wasn't investor sentiment. And it wasn't the fear trade. The real catalyst is something far more fundamental. As silver shot up to 59.37, breaking another nominal record, the gold to silver ratio crashed below 72, a level that tells you silver is outperforming gold decisively. You don't get that kind of ratio compression unless something major is happening in the industrial metals landscape. And here's where the average investor completely misses the plot. They're too focused on gold as the leader, expecting silver to follow it. Today proves that narrative is outdated. Silver didn't follow gold. Silver ignored gold. And that only happens when another industrial metal is pulling the strings. That metal just hit a record, and it's the secret driver behind today's silver surge. And no, it's not what most people think. If you think you already know the answer, you probably don't. Silver's move today didn't happen in isolation, and anyone treating it like a random surge is missing the actual engine behind the market. When a metal climbs over 2% in a single session, while gold slips and platinum weakens, you have to ask what changed structurally. This wasn't driven by retail hype, geopolitical panic, or fresh monetary policy. The real driver came from a place most silver investors barely pay attention to, even though it directly shapes more than 70% of global silver production, the industrial base metals market. And today, one base metal in particular sent a shockwave that flowed straight into silver pricing. That metal is copper, and ignoring copper while analyzing silver is one of the biggest blind spots retail investors have. Copper hit fresh record levels at the London Metal Exchange, not because the global economy is booming, but because the supply chain behind copper is fracturing in ways analysts haven't fully priced in yet. The system looks strong on the surface, inventory flowing, trade adapting. But underneath, the market is becoming increasingly fragmented. Copper inventories are being drained aggressively from Asian warehouses, and big traders are positioning themselves for shortages that aren't here yet, but are clearly coming. This isn't a typical bull market, where demand exceeds supply because of a strong economy. This is a market where financial players are stockpiling physical copper out of uncertainty and fear of disruptions. The higher copper goes, the tighter silver gets. Because silver is still primarily a byproduct of copper mining, you can't separate the two. That's what analysts like Adrian Ash are starting to point out, and he's late to the conversation. This tension began almost a year ago, and now it's hitting the mainstream because the price reaction is impossible to ignore. Copper at over $5.26 per pound creates pressure on every mine that produces silver on the side. Higher copper prices encourage miners to shift focus toward copper output, but that doesn't automatically mean silver supply increases with it. Many silver-producing regions are already dealing with regulatory pressure, declining ore grades, and operational limits. So while copper's price is exploding, silver's byproduct supply isn't keeping up. This mismatch is exactly what creates a stealth deficit that analysts underestimate every single year. At the same time, investment banks are split. Citi sees copper going to an insane $13,000 per ton by mid-2026 because of tighter balances and tariff-driven stockpiling. Goldman Sachs, on the other hand, argues there's no structural shortage yet. That disagreement alone shows how uncertain and fractured the market is. When the smartest players in the room can't even agree on the direction of a metal that underpins entire industries, you know volatility is coming. And volatility in copper always bleeds into silver, because industrial users hedge aggressively when they sense instability. Silver's industrial demand isn't cooling either. Even though mining supply is constrained, the biggest drag came from solar panels using slightly less silver per unit. But this masking effect is temporary. AI data centers, electronics, EV components, chemical applications, all of them are ramping up. You don't get a $59 silver price from investor hype. This is industrial pressure meeting financial speculation at the same time. What happened today in silver isn't just noise on the chart. It's the start of a realignment that most people still don't understand, and the market reaction is telling you exactly where the pressure is building. When silver moves independently of gold, you should immediately stop thinking like a traditional metals investor and start thinking like an industrial strategist. That's the shift most people never make. Silver is priced like a precious metal, but behaves like a strategic industrial commodity when stress hits the system. Today's price action shows that investors are finally waking up to that dual identity. And when silver gets pulled simultaneously by industrial demand and investment demand, you get a move that looks unexpected, but was actually building for weeks. This entire surge is tied to copper's behavior because copper didn't just climb, it flashed a warning. When copper hits new highs in a shaky global economy, that's not bullishness, that's fragmentation. It's a sign that big players don't trust the system to deliver stable supply. And when copper fractures, silver follows, because silver rides on copper's mining infrastructure. The price spike today is the market acknowledging that silver's supply cannot expand quickly, even if copper prices incentivize miners to ramp up production. Mines don't magically produce more silver just because copper is profitable. Silver is trapped inside ore bodies, and its output depends on geological ratios, not price signals. This is one of the biggest misconceptions retail investors have. They assume more copper mining equals more silver supply, but the numbers show otherwise. If anything, copper-driven mining squeezes silver availability because miners optimize for copper extraction efficiency, not silver yield. At the same time, the industrial side of silver is sending contradictory signals that confuse mainstream analysts. They see photovoltaics using less silver per panel and think demand is flattening. That's surface-level thinking. Solar is just one sector. Data centers are exploding in scale. AI infrastructure is consuming record electricity, and every energy transition technology requires higher conductivity materials. Silver is the best conductor in the world. There's no substitute that delivers the same performance at the same scale. So even if one industry reduces its silver intensity, the overall industrial pull remains strong because new sectors are emerging and they require purity, stability, and conductivity that copper, aluminum, and substitutes can't match. This is why today's spike matters more than the number itself. Silver crossed a psychological barrier, even though gold didn't lead. That means the market is pricing in industrial scarcity before investment scarcity. We've seen this play out before, but only during the early phases of major bull cycles. When silver outruns gold while the economy is unstable and copper is stressed, it signals an imbalance that's building faster than analysts admit. China's warehouse drawdowns prove this. Lease rates spiking in London prove this. And the gold-to-silver ratio collapsing confirms it. This isn't a blow-off top. It's the beginning of a structural squeeze forming beneath the surface. And the part analysts refuse to confront is that once silver starts pricing in industrial stress, investment demand hasn't even shown up yet. That's what makes the next phase far more dangerous and far more interesting. As we move deeper into this move, the most important thing to recognize is that silver's price action isn't just reacting to today's news. It's reacting to months of imbalance finally hitting the surface. You can already see the fault lines forming if you zoom out from the daily chart and start looking at the structural forces shaping the market. China's continuous outflows from Shanghai warehouses are a perfect example. When the world's largest manufacturing economy starts shipping silver out instead of stockpiling it, that signals internal shortages or rising domestic consumption that isn't being met by local supply. This is not normal behavior. China typically absorbs metal when it sees uncertainty, not releases it. So if silver is heading back toward London, while copper inventories are collapsing across Asia, that means both metals are being redirected toward markets where financial players are preparing for tightness. You don't get that kind of movement unless something significant is brewing. At the same time, the price behavior across the metals complex exposes how fragile the system has become. Gold hit a record in London, but still slipped on the day. Platinum weakened. Palladium saw a small bounce. None of those moves explain silver's strength. The only metal that aligns with silver's surge is copper, because both metals share a common dependency. They're essential to industrial infrastructure, and both are hitting supply constraints at the same time. Analysts keep trying to pretend these markets are separate because it makes the charts cleaner, but the real world doesn't care about clean charts. When copper breaks above previous highs, while global trade is held together by fragile, improvised supply chains, silver doesn't wait for gold to lead. It follows copper's tension instead. This brings us to the core misunderstanding still floating around. Many investors still believe silver can just be mined more easily if the price rises. But miners cannot magically increase silver production without access to new ore bodies, higher grade deposits, or major expansions that take years to build. Even with copper prices at record highs, mining companies aren't able to ramp up silver supply fast enough to meet industrial growth. Silver is not a scalable commodity in the short term. It is constrained by geology, permitting, geopolitical factors, and environmental restrictions. That's why spikes like today's aren't temporary hype. They are stress indicators. The market is telling you supply is tightening faster than projected. Meanwhile, the global trade outlook painted by organizations like UNCTAD shows a world running on financial leverage instead of real stable supply chains. Goods are moving, yes, but that movement is being supported by fragile transport networks, higher costs, and massive inventory shifts. The world appears stable only because everyone is scrambling behind the scenes to keep it that way. When you have a system this fragile, metals that depend on industrial output, like silver, become more volatile, not less. That's why silver held comfortably above $58 even after the intraday pullback. It didn't fall back into the mid-50s because the underlying demand hasn't changed. If anything, the tension is building. All of this sets the stage for what's coming next. The weekend close near $59 wasn't an accident. The market is positioning for another potential breakout when trading reopens, and if copper continues its run while supply tightness grows, silver could easily test new highs sooner than people expect. But before we jump ahead, the final part will break down what this means for actual investors, and why stacking strategy must adapt immediately. And this is exactly where most people mess up. They see the headlines, they hear the noise, and instead of thinking long-term, they panic like amateurs. But if you've been paying attention, the signs aren't subtle anymore. The market is practically screaming what comes next. You've got tightening supply, rising pressure in global metals, central banks quietly stacking while pretending everything is fine, and retail investors still asleep at the wheel. That gap, the gap between reality and perception, is where the big opportunities always live. And right now, that gap is wider than it's been in years. So if you're watching this and still trying to decide whether the metal story is hype or actually happening, look at what the smart money is doing. Look at what the charts are telling you, not what the talking heads want you to believe. The trend is shifting. The momentum is building. And pretending nothing is changing won't protect anyone when this thing finally breaks loose. But here's the good news. You're early. You're ahead of the mainstream crowd. And the more you learn, the better decisions you make. That's why I break these stories down for you. Not to scare you, not to hype you, but to keep you grounded in what's real. If you want to stay ahead of the next big move in gold, silver, and the entire commodity cycle, make sure you stay locked in right here. Thanks for watching. And as always, this is Gold Rush Reporter, keeping you informed, prepared, and one step ahead.